to PreciousMetalsInvesting.com. My name is Ted Sudol, and I have the pleasure of having as my guest today Paul Majenovic. Paul is the author of Precious Metals Investing for Dummies. He also has his own website, RavenCapitalist.com. Welcome, Paul.
Alrighty, hello there, Ted. And as many folks know, the general Dow, had breached the 16,000 level for the first time ever. So it's been having a sensational year for the most part. And I think that now is probably a good time for everybody to look at their portfolio and make sure that they're okay. I mean, right now it seems like everybody's very bullish. And I think the last time, every time you see stuff like this, remember you have like what I've always referred to in the past as the Wile E. Coyote effect.
Right.
And the Wile E. Coyote effect is that now you probably end up having all the people out there who were nervous about the stock market saying, "Oh, look at this, all-time highs, time to plow in," And it seems like most of the newsletter, pundits out there are very bullish. A lot of commentators are overwhelmingly bullish on it. And I think no problem with being in it, but I'm saying to you, this is probably a good time to be more careful and to maybe start to hedge. Some of the things that people could be doing, well, maybe put trailing stops on their most profitable positions. Right. Maybe the positions that are not as profitable. Well, the end of the year is coming, so for those who need some tax benefit with the losses, not a bad time to get out of those. Or if they're quality positions and they're low, you can always buy some more. I mean, there's plenty of good companies out there, but I just worry about when everybody plows in, what happens then? Everyone's buying, no one's selling. Then the dangers of a sharp sell-off that could really cascade downward and be a monumental correction. That is a danger. That is a danger.
I think that's a really big danger. In one of the prior videos we did on the record levels of debt margin.
All-time high.
And also, of course, we didn't mention that the Dow is 1,600, but that's
16,000.
16,000, but that is monopoly money. It's no longer U.S. dollars.
Yeah, to a great extent. Look, when you have the Federal Reserve that's pumping tons of money into this kind of market, that causes an amazing float upwards. That is probably going to continue. So could the market go to 17,000 or 18,000? Yeah, it certainly could. But does the dangers keep on growing then for the kind of correction that's happened, like say in 2001 and or 2008? I think then it becomes a growing danger. Okay, so don't think it'll keep on going straight up forever. It's time to start being cautious. When everybody is, happy and thrilled, that's probably your first indication that you should start thinking twice about protecting some of the positions.
Right, and I think a lot of the smartest long-term investors say that you should be investing when there's blood in the streets. And right now there's partying, non-stop partying.
Yeah, exactly. There is blood in the streets. I mean, you're probably good buying opportunities in the sponge and broom sector. You know what I mean? But in any case, now don't get me wrong. I mean, I don't try to speculate. I mean, there's plenty of times I've had positions that even when they were down, I didn't do anything. If I'm planning on holding them, for the long term. See, a lot of this is also situational for you. If you're the type you're going to be holding on to your stocks and they're solid companies, dividend payers, and all the other hallmarks are there, and you're planning on holding them for retirement, and that retirement's 5 or 10 years away, then whatever correction occurs, don't sweat it. If they're good companies and they have, they're raising their dividends every year, so there's plenty of things you can just keep on holding. You know what I mean? But I do know some people who will do some defensive measures. That's up to you. It depends on how aggressive you are, what's your personal situation. Look, if you're going to retire in 6 months and you desperately need the money, then I would put, say, stop loss orders on everything so that, again, you'll have no limit on the upside, but you'll have limits on the downside, and you'll thank yourself. And again, that's situational. If you're not going to retire until 5 or 10 years from now, then I wouldn't sweat any short-term corrections, especially if you're in quality companies, okay, and you're there for the long-term dividend growth. So just check with your financial advisor about what's appropriate in your situation.
And I think that's the best advice. Even though there is a lot of euphoria in the marketplace right now, you should be more careful.
There you go. So we wish you continued success. So stay tuned for more commentaries in due course. Okay. I'm glad I'm a guest. I'm almost a regular.
Yes, you are. Well, thank you for being with us here at PreciousMetalsInvesting.com. Make sure you visit Paul's website, The Raven Capitalist.
See you next time.
Thanks a lot.